Okay, here's an exercise for two receivables. One is account receivable and another is interest receivable. The account receivable comes from delivered services for $1,000 worth, and the interest receivable comes from investments in an asset or security called a government bond, which is at a $500 interest. So at the year end, the company is filing all the records and producing the year end report. So this $1,000 receivables or revenue earned will be put on the general journal, and so is the interest receivable. So what you see here is that for account receivable, first you need to determine what the balance equals. And now there's no balance for account receivable, but at the year end, you just earned $1,000, and that is a $1,000 account receivable, which is the bills to be collected in the future for the service you've done today. So the adjustment is 1,000 on the debit side, and because account receivable is the assets, when it increases, that's a debit. And on the other side of the T account, you will see the services revenue is recognized just because you have done your hard work for your client. Your hard work should be recognized, although you have not been paid in cash yet. So revenue also is a part of equity. When equity increases, that is a credit. For interest receivable, it's the same story. At the beginning you have a zero balance, which is unadjusted, and then at the year end, you recognized that for the past 1 year, you have earned $500 interest, but you have not get that interest in cash yet. But you do have to put that number in your financial report. So what you put here is $500 interest receivable. You will receive the interest in the future someday, but not just today. It is still recognized as an asset for the company. And when it's assets and that increases, then this should be a debit. On this general journal, you shall see that interest receivable got an increase as assets, so it's debit, and the interest revenue, which is generated from your government bond investment, also increase. And any revenue should be a credit if it appears. All right, now let's study how this accounting adjustments work. First and foremost, let me do a grand summary of the deferrals and accruals we learned today. So the adjustment include deferrals on the top, which is the cash paid or received earlier, and then expense or revenue recognized later. You see, money comes first, the stuff and the services comes later. That's called a deferral. And for accruals down the bottom, it is the expenses or revenue being recognized earlier, and then cash being paid and received later, or cash after expense or revenue recognized. Okay, so this upper part basically tells you cash first. This lower part basically tells you cash after, cash before events or cash before transaction, and here's a cash after transaction, cash after events. And for the deferrals, we also further divide into prepaid expenses and unearned revenues. For prepaid expenses, this is an asset. Okay, just like you pay 24 months of rent all at once today, and you don't need to worry about rent payment for next 24 months. That's an asset. And if as the time goes by, and here is a very important precondition, time goes by. So how do we do that adjustment when time goes by from now to the next month to the end of this year and so on? So when time goes by, then you will see that the prepaid expense as the assets actually reduces value. It's because as time goes by, you have expenses being incurred every month and every year. So for the rent example, although you have a paid 24 months of rent all at once, but next month you only have a 23 of a rent paid, and then move to the next month, you only have a 22 months paid for the future. So that assets actually reduced. And then you will see the expense being incurred, and when expense incurred, that should be a debit. And this expense in the example is the rent expense. And for unearned revenues, as time goes by, you have to work and then earn the money you received earlier. So unearned revenue is a liability. That basically means although you have not done any work today, but you have already been paid today. All right, so cash comes before. And then as time goes by, you're not getting paid whatsoever, but you have to work towards the end of whatever the period for your service is. Okay, so for unearned revenue, it is a liability. As time goes by, the liability becomes smaller and smaller just because you work more and more and you have less obligations to work. So when liability decrease, that is a debit. And for the revenues, you have more and more revenues being recognized as you work more and more. And when revenue is recognized and revenue increased, then that is a credit. And for the accruals, we have accrued expenses, we have accrued revenues. Once again, these are the expenses, revenues. These transactions happen before cash is involved. So for accrued expenses, that basically means you have already made the purchase, you have already bought the supplies or equipment, but you have not paid yet. Instead, you will pay it later. It's like accounts payable, which is a liability to you. You have to pay money in the future, just like you pay back your loan. So when a liability, when the time goes by, the liability would reduce its value. So right here, you will see the expenses being incurred, and when expenses increase, that's definitely a debit, but this liability should also increase just because you incur more and more expense, and that actually goes up. So, and that should be a debit. All right. And right here, you have accrued revenues. Then accrued revenues basically is accounts receivable coming from the service you have done today, recognized today, but you are not paid yet. Okay, you have not received payment yet. That basically will you will basically wait for future payments, and when you have a more and more revenue being recognized, then this would be an increase in assets. That is a debit, and when you have more revenue being recognized, then that is a increase. That's a credit. Okay, and once again, revenue is a part of the equity. So when it increase, that's a credit. And on this side, you see that as time goes by, the expenses will be incurred and it will become more and more. So that basically means before this expense increase, the current expense level, which is before adjusting, is lower. So that is understated expense. And for the assets, before the adjustment, the assets level is higher than after adjustment. So the assets is overstated before adjusting. And for this liability, because the value of the liability is getting lower and lower. So before adjusting, the liability is higher, and that is an overstated value. And for the revenue, it's getting more and more, but before adjusting, the revenue on the book is understated, is lower than they actually are. So that's called an understatement. For accrued expenses, when there's a more expense being accrued, then that means before adjusting, your expense is lower. So that means your expense is understated, right? And for liabilities, it will increase as more and more accrual expenses added up. Then the liability will increase later. But for now, the liability is lower. It's called an understatement. So you can develop the same story for the assets and the revenue before adjusting this accrued revenue. Now let's prepare an adjusted trial balance. In the previous chapter, we have learned how to construct a trial balance based on the transactions. So our transactions involve cash to account receivable, supplies, all the way to revenue expenses. So you have a total which is for debit, and you have a total which is for credit. And then because the time goes by and you need to take a look at the changes for certain items. For example, if account receivable is increased, then you need to add a number there. That's a asset, so that's a debit. And if prepaid insurance as time goes by goes down, then that's a credit. Okay. And also if your supplies goes down, that's also a credit. And for the liabilities or equity, when they increase, that's a credit. When they decrease, that's a debit. And for revenues, so when they increase, that's a credit. And for expenses, when they appear, that's a debit. So you're gonna do the summation of a debit and credits for all of these items when they are adjusted. So in particular, you're gonna develop another 2 columns for adjustments, debit and a credit, and then add them up all together to get this total. And your adjusted balance, basically here, this is 47,610 is a summation of 3710 plus 45,300. Okay, so the debit here plus debit here will be the debit right here at the trial balance adjusted term. And you can also get the adjusted balance for each of these individual items. For example, this 0 plus 1800 will give you 1800, and this 2400 minus 100 will give you 2300. Okay, so you can get the adjusted accounts for each of these accounts, and then add them up, okay, to get this overall debit for the adjusted trial balance. And this overall adjusted could be obtained also by adding the overall adjustments to the unadjusted. All right, here let's prepare financial statements. And step number 1 is to use the revenue and expense from the trial balance. And step number 2, we prepare the owner's equity using capital withdrawal accounts from a trial balance. Well, you can read step 3 and step 4. I just do not bother to read it here for you, so to save some time. So let me just show you how exactly we do here. So step number 1, from this trial balance with all this account title, you have already put the number in either in debit or credit. So you are going to extract all the revenues and expenses first. You see revenues are here, the expenses are down here, and they all come from this adjusted trial balance. And then based on the adjusted trial balance, you are going to prepare an income statement. An income statement basically is the revenue minus all expenses to get net income. The second step is to add net income to the owner's equity statement. And for owner's equity, you need to have an owner's capital, which is here, and owner's withdrawal, which is right here. So you will add two other numbers to these statements in addition to net income. And the total, you have three accounts. You add all the three accounts. One is capital, one is net income, and another is withdrawal. So you will get a total equity. Then the next step is to add a total equity as part of the balance sheet. So total equity is here, and then you get also get a total liabilities, which come from account payables, salary payables, unearned revenues. So these are liabilities being grouped together with this subtotal of 9,160. And then you need to put all the assets together. So these assets individuals are cash, account receivable, supplies. You gotta put them all together right here. So although you have two columns of a number, right here you only have one column and one column of numbers. This is fine. So when we do the addition and the subtraction, if it is recorded as a for assets, if it's recorded as debit, we just put it as a positive number here. And for liabilities, if it's recorded as a credit, we just put it as a positive number here. And for equity, if it's recorded as a positive, as a credit, we put it as a positive. But if it's a withdrawal, which is a debit, we're gonna put it as a negative. So this is a negative 200. We will deduct this 200 from the equity plus net income. And for all the revenue accounts, they would be recognized as, they would be put as positive numbers because revenues are credits. And for the expenses, they are put in a debit part, and they will be put on the income statement as negative numbers. So positive, negative combined together, this would give you net income. So don't worry about having a debit or having a credit. You don't have that kind of format in these financial statements. So if it is a debit, you just put a positive or negative to stand for debit and credit. In regard to which one is a debit, which one is a credit, it really depends on the financial statement. If it is in the balance sheet, the debit will be a positive number. And if it is the income statement, then the credit would be positive numbers, and the debits from the expenses will be negative numbers to be deducted. All right, and here is a trial balance for a company called Magic, and here you have these items from a cash, account receivable, land. These are assets. Account payables, long-term payables, these are liabilities. You have a capital, withdrawals, earned revenues, and the salary expenses, and office supplies expenses. So the first step is to generate the income statement. So the revenue is put here, and these are negative numbers. You can put them in the same column. You don't have to separate them. So there's 79,000 minus 56,000 minus 8,000. So you will get a net income of 15,000. And then based on the 15,000 net income, you add to the owner's equity statement, and you have a 75,000 for owner's equity minus 20,000, which is debit. That's a withdrawal. So it should be put as a negative number down here. And after you get total equity, you will put a total equity as part of balance sheet together with total liabilities, and these numbers will be added together. So although these are all credits, but we just put them all as positive numbers. But for assets part, although for all the assets they're recorded as debits, but we all put it as the positive numbers here. And eventually you will see the summation of all the assets individual items are the same as the summation of a total equity and liabilities. And now you're done with this financial statement. So the financial ratios related to this chapter is a profit margin. Profit margin is net income over net sales. So it is a percentage of the sales that will eventually be part of a shareholder's wealth. So that part is called a net income. And for your calculation, you will see a company here with net income on the top row and net sales in the second row. So the profit margin is roughly 7 to 9%. And if you compare the industry profit margin, you can see that the company's profit margin beats the industry. So that's a pretty good company. And we always want this net income to be as great as possible. Well, because net income, you know, from the statement of owner's equity, net income belongs to shareholders, belongs to the owners of the company. All right, so you just want to make sure when you invest in a company, you can get enough return. And that return is scaled by net sales. Well, you see that certain companies would be operated at different levels. Some companies' sales would be in billions of dollars and some just in millions of dollars. If you just compare the dollar figures, it's not an apple-to-apple comparison. So that's why you need to convert into percentage by using net income divided by net sales. Another ratio we actually did not study in chapter 2, and this is coming from chapter 2. It's called debt ratio. And debt ratio basically is total liabilities divided by total assets, and that evaluates the level of a debt risk. So if there's too much liabilities, you have too much obligation, and you have to pay a lot of money in the future, then that's definitely a not good sign for a healthy company in the financial aspect. So definitely you want to keep down this debt ratio to a satisfactory range. And if the debt ratio is too high, then that's a greater probability for a company to fail its debt payment. And when a company is unable to pay back its debt, what do we call that? It's called a bankruptcy. And this is a debt ratio calculation. Use the liabilities from the balance sheet divided by total assets. So you will get a total debt ratio. And you compare the debt ratio against the industry debt ratio on average. And for this company, you will see the debt ratio is lower than industry average. So this company's debt is controlled. It's not under a huge financial distress.